This week, the S&P came very close to reaching a historic high, but closed weak on Friday. When adjusting for dividends, that didn't stop the Spy Etf that tracks the S&P 500 from reaching a new historic high before slipping back into the range. Jesse Livermore would have called the correction a normal reaction to price momentum passing through an actual point of value and, like a pendulum, swinging back the other way, clearing the way for price to then march on. If you're afraid of heights in the market, we'll look at how price must clear an old high in order for the bullish trend to resume, and we'll bust the myth of an aging bull market. We open with a summary of this week's economic data and interpretation. This week featured a lot of data on inflation that is important for the path of the Federal Reserve. Once again, the most awaited reports were at the end of the week. CPI showed the hottest consumer inflation since 2008, and core CPI showed inflation rising above the Fed's target rate. As we'll see, this was one of the factors giving the market pause at the end of the week. Now we'll look at our week in review, where we take a look at the headlines and how they moved the market. On Monday, stocks rose on robust earnings. On Tuesday, stocks continued their rise on strong earnings. Wednesday, the market closed down slightly as the U.S. and China escalated tariffs and the major indexes approached new highs. On Thursday, indecision turned into a decline by the end of the day on growing unease over the effect of sanctions and tariffs in global markets. On Friday, continuing concerns and a crash in Turkey's currency caused heavy selling in the market. To end the week, there was strong buying at the end of the day, as you see by the last long white candle, but as you'll see, we slipped below the point of a breakout. For the week, we closed roughly flat, and the month and year-to-date statistics are provided at lower right. To set the table, let's return to Jesse Livermore and trend following. Here's a line chart of a stock. Jesse Livermore would have referred to this consolidation as a normal reaction, where the stock pulled back to consolidate its gains in a bullish trend. Price could break up or down from the range. In this case, price broke up. To break up over the previous high, the stock by definition makes a new high. This is the point where Mr. Livermore would have bought if he didn't already have a position, or in his terminology, if he had an existing position, he would have added to his line. Looking at how a stock makes a new high is important for determining if a stock has reached a top or emerged from a consolidation to continue a bullish trend. Now that we have some context, it's time to look at a new all-time high in the Spy Etf, which tracks the S&P 500, fear of heights, and the myth of the aging bull market. This is a chart of the SPY showing the correction from 2015 through 2016. Price peaked in July 2015 and consolidated for a little over 12 months. During the sell-off, the index, which is market cap weighted, dropped 15.8%, while the average stock in the index dropped 25%. This is important because going back to the days before we had computers to produce charts, a bear market was defined as a decline of 20%. A decline of 19.9% doesn't feel any different than a decline of 20% when you're watching your portfolio. So the 20% is a rather arbitrary number. We've shown in previous videos that the current bull market started in 2013 when we surpassed the 2008 highs. What we're showing here is a reset and a resumption of the bullish trend. For those hung up on a 20% number, a decline of 25% in the average stock meets this criteria as well. Looking back at the consolidation itself, price tried to break out of the consolidation in April and met with overhead resistance here and here. You'll see why this green line is important in a moment. Price finally breaks decisively out of the consolidation in July 2016, making a series of new highs in an upward rising channel. Lines of prior resistance and the tops of consolidations often become support that the market retests, and that's precisely what happened here before price continued to move on. So, should you have been afraid of new highs? The market makes new highs all the time, and as we discussed in last week's video, we use our model to help distinguish between new highs and tops. As you can see, the market continued steadily higher throughout 2017 and again needed to consolidate its gains in the 2018 correction. Mark Lim describes the technical factors that promote trends following emergence from a consolidation. Using technical analysis and historical patterns, we know there's a high probability of the bullish trend continuing when the market makes a new high after a consolidation, as is the case now that we've emerged from the 2018 correction in the Spy Etf. New highs in the NASDAQ also bring up fear of heights and memories from the top reached in the 2000 dot-com bust. So naturally, it's a good place to explore fear of heights and put heights in perspective. Let's apply what we've learned about short-term corrections by looking at a much longer time frame. Following the 2000 dot-com peak, the NASDAQ consolidated for 16 years before breaking out to a new high. From the low in 2002, the NASDAQ made a series of higher highs and higher lows until 2008. Here we see an interesting bullish pattern called an inverse head and shoulders. The initial drop from the peak forms the left shoulder. The plunge to the bottom forms the head, and the normal reaction, as Jesse Livermore would say, after the run-up from the bottom forms the right shoulder. The upside target price from this pattern is the distance from the neckline of the pattern to the head. An area of prior resistance from a peak in 2007 becomes support, and the bullish trend out of the inverse head and shoulders pattern continues. The NASDAQ makes a new high and breaks out of the pattern in 2014 and retests the top of the consolidation, which now becomes support. As Mark Lim noted in the previous slide, longer consolidations produce longer trends. The market had a small consolidation by comparison in 2018 and has resumed the bullish trend. As you can see, with the 16-year consolidation, we would expect a bullish trend to have a similar length, and we're only 4 years in. This is based on probabilities and is not a forecast. The probability of a pattern failing to repeat or an unforeseen shock to the market is never zero. This is why we use stops to manage our risk, but this is also why we look at long-term patterns and probabilities in the market. This chart from last week's video is a daily chart of the Spy Etf. You see that price tested the red line of overhead resistance from the January high, found support at the green line, and was headed toward another test of overhead resistance. What happened next? Here's the same chart prepared on Wednesday, August 8, 2018. Looking at right, price broke above resistance to reach a new all-time high after almost 7 months of consolidation. These support zones are often retested and confirmed before price continues to move higher. Remember our quote from Mark Lim about longer consolidations producing longer bullish breakouts. I'm adding the slide prepared on Friday to this pre-recorded section of the video because of new developments. Today, we slipped back below the January high and below the breakout. Price found support at the 20-day moving average shown in blue, and this candle has a long lower shadow, reflecting the end of the day buying that we discussed in our week in review. There's additional support here from multiple closes. A retest of support areas before clearing the range again is not unusual, and the current price action doesn't change the overall collection of evidence in support of the bullish trend. So should you be afraid of heights, or are we going to find new footing on the way to new highs? Judging the probabilities from a very long-term chart going back to 1925, the probabilities favor new footing for the continuation of the current bullish trend. An additional item to call your attention to on this chart is a repeating bullish pattern similar to the inverse head and shoulders pattern that we saw on the NASDAQ chart. Note that coinciding with all 3 long-term periods of consolidation, we had a pattern that was very similar to an inverse head and shoulders. As always, there are a host of worries and plenty of reasons to be optimistic. That's what makes a market of buyers and sellers. Things could always tip in the other direction at any time. But our job is to stay focused on the long-term probabilities based on the evidence on the current charts. And this is the secret to increasing potential for long-term gains. Even if you have a long-term trend following model and have studied your market history to be able to discern between market tops and new all-time highs, it's human nature to have a fear of heights. Just remember, as Robert Arnault said, in investing, what is comfortable is rarely profitable. The information in this video cannot address the specific investment objectives, financial situation, or particular needs of any viewer. The information presented is solely for informational purposes and is not a solicitation or offer to buy or sell any security or financial instrument. None of the information in this video should be taken as investment advice. Any opinions expressed in this video are subject to change without notice. Caliber Capital Management, LLC, or KCM, is not under any obligation to update or keep the information contained in this video current. KCM, its officers, employees, or clients may have an interest in the securities, related securities, or derivatives of the securities referred to in this video. KCM accepts no liability whatsoever from any loss or damage of any kind arising out of the use of all or any part of this material. KCM recommends that you consult with a licensed and qualified professional before undertaking any investment decision.